My name is Julie Moon. I'm Senior Research Analyst with Finovate, and I'm excited to bring you today's webinar, Gloss Without the Undercoat, the Longer-Term Results of Digitizing Without the Right Foundations. Our speakers for today are Bob Meara, Senior Analyst for Retail and Corporate Banking at Celent, and Andrew Stevens, Global Principal for Financial Services at Quadient. So over the course of the next hour, Bob and Andrew are going to be looking at some new research results, uncovering critical gaps in the customer experience, and recommending some practical steps in joining the digital transformation movement with longer-term sustainable cost savings. Just one housekeeping note before we get started. We will be hosting a Q&A session afterwards, so feel free to enter any of your questions in the Q&A box in the corner. And Bob and Andrew will address them at the end. With that, I'll hand things over to Bob to kick things off.
Terrific. Thank you, Julie. For those of you who may not know, Celent is an independent technology research and advisory firm focused on financial services. So we have practices in banking, insurance, capital markets, and wealth management. We are a division of Oliver Wyman, so our parent is a large global management consultancy. And I've been at Celent for 15 years. During those times, much of my coverage areas have involved retail delivery channel technologies. Those have classically been independently built and siloed technology stacks and independently built and managed organizations within retail banks, both small and large. And those stubbornly resilient legacy technology stacks really are at the heart of, among others, are at the heart of the gloss without the undercoat message we'd like to convey today.
Great. So Bob, it does look like the audience is able to see your screen, so you can go ahead and kick things off.
So what I'd like to do is speak to the evolution of customer engagement in retail banking through the lens of how it's evolved over the 15 or so years that I've been involved in it here at Celent. Clearly over that time, things have been evolving dramatically. Some say they've changed and have changed forever. Others not so much. I think for many of those years, particularly in the early days of mobile banking, many bankers needed some encouragement to take the channel and the evolution or change in customer expectations seriously. For many of those years, in the current environment, I wonder if maybe the pendulum might have swung a little bit too far in the other direction, where banks tend to maybe overstate the digital imperative, so much so that they're neglecting very important human-to-human customer interaction opportunities with their clients. And I'll speak to that today. So no discussion of this topic really should take place without at least recognizing the last 18 months, right? A once-in-a-lifetime experience for many of us, in which banks all over the planet dropped and pivoted mightily and swiftly to embrace new urgent priorities. Many did so with great skill and boldness, and we saw unprecedented declines in gross domestic product across many geographies, and it's been a sucker punch to many retail banks. But alas, many have recovered quite nicely, and we think looking ahead that there's really maybe at risk of overstating it ever so slightly, an unprecedented opportunity for retail banks going forward. But we think that's going to require a few things, and one is a very different mindset, particularly around the purpose of the financial institution and the real value that you're providing to your clients. That in some ways, you could say nothing's changed there because you might have the same sort of product portfolio that you've had, but really the way it's being embraced by your customers on the retail banking side is quite different. And we think it's going to require new capabilities, both technical and organizational, and in many organizations, cultural capabilities as well. And I'll speak to those in a moment. So a few weeks back, Celent produced a free on-demand webinar. The term for it, we called it previsory, and that meant to be kind of a preview advisory of the coming year. And so other technology research firms have, top trends kinds of reports and webinars, and this was indeed one of those. And what we did in the webinar, it's available on at Celent's website for no cost. One would just need to register to our site. But we identified 5 technology trends that we think are going to be among the most important in the coming year, as well as some key imperatives associated with each of those trends. And you can see those on this slide now. I won't speak to this, only briefly, but to note that if you would like to dig into this in a bit more detail, again at no cost, please visit our website, and that'd be another 30 to 40-minute discussion for you. What I'm going to do today is focus on the top right, and that is the idea of optimizing customer engagement and delivery. And in the context for that, of course, is the massive pivot to digital that we've all witnessed. So in Celent's view, many banks, maybe most, know what optimal customer engagement should look like. The problem is delivering it. Now there's many moving parts to this topic, and so let me use this slide to kind of connect the dots, if you will. And this is Celent's view of how things are coming together. In the center, of course, is the shop, buy, use continuum, right? The long-term customer life cycle. Customer engagement is vital, of course, across all parts of the life cycle, and it's increasingly taking place across a growing number of points of engagement. Things like branches, of course, contact centers, ATMs, but mobile devices and even wearables. And on the top right, there's a growing number, top left, a growing number of customer engagement mechanisms within those points of engagement. So not only do we have telephony, of course, on our phones, but chatbots and live chat and email and things like even third-party platforms. The topic of embedded finance is another critical, beyond today's topic, but another critical topic of importance. And customer engagement, now moving clockwise, is increasingly personalized. Done well, it is a result of human-centered design principles. But it's not just technology, right? Of course, it demands rigorous training for banks' frontline staff, because not all engagement is digital, and not all digital engagement is necessarily intuitive by customers, particularly those who've not embraced digital for years, but are digitally active today. Approaches to this engagement used to be entirely reactive. You'd build branches and place them in convenient locations. You'd have them open during convenient operating hours, and you'd have contact center staff ready and waiting for customer or the arrival of customer inbound calls. Entirely reactive proposition. And while we think that's continued important to do so, we think real and net new value is delivered when banks wisely adopt more proactive ways to engage with their customers. Doing so, however, is very difficult. And that's because there's a very small line, a very thin line separating delighting customers and annoying the tar out of them. For example, my guess is you probably got 3 to 4 dozen alerts on your phones on Black Friday, right? Did you need further alerts for another advertiser to remind you it was Black Friday? Probably not. So there is quite a fine line, and determining where that line is and delivering it at scale with each and every customer who might have very different needs and preferences is the key challenge of proactive customer engagement. Doing that requires a technology environment that increasingly is reliant on third-party partners, third-party sources of data, and even third-party platforms, for example, embedded finance. And doing this well on a client or customer by customer basis requires sophisticated and real-time learning systems, things involving, for example, real-time feedback or A/B testing. and machine learning. And these things done well can be a step change in your ability to engage customers across this increasingly digital and increasingly complex layer. But alas, for many banks, it remains easier said than done. Well, of course it is. Everything in life is easier said than done, I suppose. But customer engagement, I think, is a particularly challenging pursuit. And let me tell you why I say that. During the pandemic, many banks pivoted quickly to invest in their digital channel capabilities. That was the #1 priority in survey after survey through Celent's eyes. And the #1 digital banking technology priority was customer acquisition or account opening, the ability to sell and acquire new customers in an entirely digital process. Most banks started with account opening, and many, but yet now, despite all the rapid progress made over the last 18 months, there's still considerable work that remains on that front, not to mention lending and other products. Banks are slow or struggle as well to complement digital channels with human assistance, giving customer-facing staff the right tools that they need. In a late 2020 survey, disconnected digital and assisted service channels was the highest point of friction, or the highest barrier to many banks' digital transformation plans. And lastly comes the branch channel. The branch channel has been in the news a lot since the pandemic, with many pundits predicting that the branch is entirely dead. Now, many have said that for years, but it took a hit over the last 18 months like never before. Banks are taking steps toward, as a result, rationalizing their branch portfolio. But among all the things we've discussed, that probably is the most difficult, time-consuming, and expensive. Heck, just replacing a receipt printer in a modest-sized branch network is $1 million proposition. What worries me in all of this are two things. One is a digital-only mindset, and I hear many pundits and many banks kind of articulate this. And one thing I've heard many times, you've probably heard it as well, is a saying that once they go digital, they're never going back. Well, I wonder who they are. Are they most customers? I think not, and I'll show you why in the coming slides. In Celent's view, they represent a very important minority of customers for most established institutions. If you're a digital-only bank, well, they represent all of your customers. If you're a traditional financial institution, we think they are a growing minority. And the second is what we call self-service myopia. And that's the idea that the future of customer engagement is personalized, automated, and digital. Absolutely it is. But that doesn't mean it's always digital, and that doesn't mean it's always self-service. And I think probably every bank on today's call would acknowledge that. But as we look at how banks are spending and where they're investing in capabilities, they are very lopsidedly investing them in digital self-service. As important as that is, I think many banks are missing the boat. Here's an example. As we all know, when banks across the globe closed branches as a result of the pandemic lockdowns, branch foot traffic plummeted. Of course it did. The front doors were locked until it didn't plummet. This graph reflects the results of a late third quarter 2020 survey among a handful of retail banks in the US. The question asked here is, how much is branch activity affected during the lockdown? Indicate your average monthly transaction volume compared to pre-COVID baselines. And so you can see the range of responses there. The responses in orange reflect how things were at peak lockdown. Massive erosion in branch foot traffic. But look what happened a few months later, post-lockdown. Foot traffic all but resumed pre-COVID-19 levels. In fact, in that same survey, collectively, those banks forecasted that in 2022, they would see roughly a net 15% decline in footfall compared to 2 years before, pre-COVID. So as disruptive as the pandemic has been, many of your banking customers already have or will revert to interacting with the bank the way they always have. Worse yet, 2/3 of new sales are generated in the branch at many banks. In the same survey, we asked banks what the current state was. This is again October 2020, and what they would anticipate 1 year from then, which is roughly now. And you can see they expected a growth in digital customer acquisition, but not dramatically. Frankly, a modest year-over-year growth, given the investment and time and effort invested in digital customer acquisition over that time frame. But it gets worse. What we find is human-to-human engagement is absolutely critical to maximizing customer long-term value. The data I'm showing on this slide is from a separate survey in August of this year, and it was focused, it was a very deep dive into operational benchmarking associated with digital account opening. So simple products only. We examined a variety of operational metrics among a group of some 20 US financial institutions. And we found that, and this is rigorous data provided by the banks anonymously, that we found that cross-sell rates are considerably higher in the branch than among customers acquired in other channels. Again, testimony to the value of human-to-human interaction in the sales process. We found that in-person acquired accounts generate more deposits on average than digitally acquired ones. And we found that digitally acquired customers attrite at much higher rates. That graph is on the lower left. It's alarming, the attrition rates among newly acquired, digitally acquired customers. So don't misunderstand. Anything I'm saying here is to suggest that digital selling is not important. It's imperative. What I am saying is most banks have a long way to go to fully utilize it. And in the meantime, many are neglecting the branch experience at their disadvantage. But it gets even worse. All this growth in digital customer utilization, many banks pre to post-COVID suggest they've grown their digital active customer base by as much as 20%, a massive year-over-year growth. Despite that, high call volumes and long customer wait times remain a key challenge among contact center executives in these same banks. Said another way, this growth in digital customer utilization hasn't yet produced the promised reduction in call center volume. Ironically, in many banks, these newly digitally acquired customers were a key contributor to high call volumes. I mean, think about it. Many banks have evolved their digital channels significantly over the last decade. And many of your customers have enjoyed the improvements you've made along the way, but those who have come late to the game, these late adopters, are looking at a very complex, oftentimes difficult to understand and navigate digital platform. And so they're picking up their call and asking your frontline staff to help them. And despite the growth in the number of digital engagement methods that I spoke to earlier, many banks are slow to serve customers in this growing bevy of channels that customers prefer to use. Most all banks offer digital voice and interactive voice response, or IVR systems, right? They've been in place for decades. The clear majority use one or the other, or both. And that's typically delivered via a contact center platform. Live chat is just barely over 50% of US banks deploy live chat, and it's typically done with another siloed system. Even fewer are offering secure email now, and that's, again, another siloed system. And social media messaging is embraced by even fewer institutions. And this is from an October 2021 survey, so fairly current data. So one reason, at least one of many reasons, progress is slower than it could be, stems from these stubbornly resilient, siloed organizations and systems in many institutions. Gloss without the undercoat, if you will. And the result is broken customer journeys, poor customer experience, and considerable technical debt. So with all this bad news, all these challenges, and the imperative to transform digitally with great speed, what's a bank to do? I'll offer 4 quick comments before handing it over to Andrew. First, I'd encourage banks to embrace a digital first, not a digital only mindset. And secondly, and then maybe as importantly, please understand that digital doesn't mean self-service. Digital is a way of doing things, not an outcome. Third, automate the routine without shunning human-to-human engagement. Complement the digital channels with human assistance in unique, timely, convenient, and relevant ways. Give customer-facing staff the right tools so they can be effective and efficient in serving customers when customers choose to interact with them, human to human. And then lastly, be careful how you build. I may have, if we have time later on, I'll give an anecdote about a Western U.S. credit union, very much mired in internal debates on how to build. Celent's advocacy is this. Monolithic systems, particularly back office systems, abound in financial institutions across the globe. We think if you've not abandoned them already, you need to have your sights on migrating off of monolithic systems to an IT environment comprised of composable building blocks from a growing ecosystem, again, third parties involved, of diverse technology partners in the cloud. I know those are trendy terms, but our experience is that banks who not only have their sights on delivering this all-important customer experience, not only are they well down this journey, but they were identifying this evolution and began their migration years ago. And chances are the larger your organization, the longer this will take. So being very important, how you build is difficult to overstate. Andrew, over to you.
Thanks, Bob. Always thought-provoking. I love hearing your views. Before I begin my part, I do need to apologize for my gravelly voice today. I don't normally sound like this. If I suddenly go quiet for a moment, I'm just saving you from hearing me cough or very loudly blow my nose. Hopefully I've not dropped off the call or anything like that. And if you actually want to ask anything to either Bob or me, don't forget to fire it into the Q&A box on your screen. We'd love to hear some of your trickier questions. So for my part, I was sitting listening to Bob, thinking about how am I going to open my section, and it occurred to me that we've been talking together privately and actually in these formal public webinars for years now, really about how the digital channel needs to be very, very carefully managed so that it becomes a valuable addition rather than a dangerous blocker to the customer experience. And for me, the reason that that's always been an important conversation is been around that relationship with the customer. Every financial institution wants a positive relationship with the customer because that's how you get people to come and buy more products even when they're not at the market leading rates. When you walk through a door, somebody smiles at you or someone greets you by name on the telephone, you feel like you're part of a relationship. When it's all impersonal and digital, and if you're thinking of digital as fully self-service, as many people do, despite Bob's recent warning, there's so much more work required to keep up that relationship. The risk of not doing it is our customers start to think of us as a utility, something that exists, but it isn't loved, necessary evil, if you like. At that point, we're more at risk of losing a share of the wallet to our rivals, that much higher attrition rate that Bob mentioned. And nobody wants that. So let's fix the problem by making sure we've done the groundwork. We've put those undercoats on before we try and gloss. Firstly, by by improving our digital offerings so that they work better for our customers, and then by remembering that digital isn't the only way that most customers think of us. If 2/3 of sales are in the branches, we need to benefit from the best of both worlds somehow. But how? What are the first practical steps that we at Quadient would recommend that you make to change based off Bob's recommendations and some more from us? And for me, being careful about how you build starts with a mindset change. So I've couched my recommendations in the form of simple but fundamental questions that you need to start asking. The first recommendation that I'd make is you need to focus on the why. And when you think back to Bob's part of the presentation, there's a whole host of thought-provoking why questions that come out of it. But we don't always have the benefit of a respected industry analyst sat next to us to interpret them for us. So we need to learn to do the same every time we look at an opportunity. And the why is actually an unusual question for us to ask. We've become really good at understanding what results we want from our solutions, thanks to all sorts of marketing and the natural peer pressure that comes with seeing someone else do something that looks interesting and naturally assuming that it must have been successful. But if we just focus on the what, we're putting that short-term gloss on something that won't last. To get it right, we need to focus on why it's going to make a difference. And in doing that, we need to spend time understanding our customers. And customers are the most amazing things. They're all different. They don't necessarily have the same needs, the desires, the pains, the aims for their relationships with you. They're not products or resources. And they come with a whole raft of data. That's great, but you can't necessarily understand them just by putting the data in a chart and comparing them. It's easy to say, oh yeah, we just need analytics. But when it comes to understanding the customer, it's not your standard run-of-the-mill results that you're actually looking for. So place a lot of focus on working out how you can understand what your customers really want and need. Not what you would like them to really want and need. And we've seen from Bob's talk, there's a big gap between the publicity around digital and the high level numbers, and then the real world that we're all facing today. So the key why questions that I recommend you always ask are, why would the customer care about a new digital function, a screen, capability? It doesn't really matter what it is. Why would the customer care? And note as well, it's not why should they care. They don't know how much hard work went into your solution and how much they should appreciate you for it. They don't care unless it gives them a perfect result. And also, why would the customer want to switch channels away from this? In which cases have we not got this right? Or perhaps we have got it right and we want customers to switch channels. Because if we know it's planned, we can plan for their handoff and we can keep the experience level high. The best ways of answering those questions are to map the journeys that your customers take. Not on walls with sticky notes like in CX 101, using software that allows us to actually collaborate remotely and make sure that our journey maps are always up to date. And if you're doing that, make sure you add in the data. Because when we try to define a customer in a single graph, we oversimplify. But when we visualize the paths customers take through our organization, and then we layer in the specific data from each step over the top, we start to create living, breathing dashboards that we can use to prioritize our improvements and to track our results as well. And that's across all channels, not just the digital ones. So when we've planned for handoffs across channels, we can see how well they're working, where our drop-offs are, and we can constantly improve them. And we can also see where the handoffs are that we didn't plan, those extra bits that are suddenly appearing there, and we can fix the problem that's causing them. I'm guessing all that branch traffic and the contact center traffic that Bob's slides suggested, they weren't planned for. So why is it being caused? Second point will be to focus on the who. Who within our customer base do we care about? I've already said that all customers are different, so you get three choices here in my view. You can focus solely on one segment of your customers, that important minority that was mentioned. That's what fintechs and neobanks have done. They only want the digitally native customers in most cases. You can ignore the rest. Works well if you only have one type of customer. As much as we'd like to pretend, most of our customers do want to use channels that aren't mobile and internet platforms either some of the time or all of the time. So ignoring them is likely to upset them a tad. And somebody's probably going to capitalize on that, and it won't be you. Or you can build the one-size-fits-all solution that everyone's got today and really annoy most of your customers, because there's no such thing as an average customer. So you end up meeting nobody's needs. Think back to the why questions. I mean, why would a customer really care about the solution that you provided if it's not perfectly tailored for them? Why are they switching channels back to the branch like Bob's data showed? Perhaps because they get a more coherent and personalized service. Or you've got a third option, and that's to build solutions that actually work for everyone's needs. To do that, we need to be able to orchestrate experiences around every individual customer. Taking all the data we learned from our why questions and our understanding of the journeys that they're likely to go on, and then taking unique actions for each customer that helps them get to their individual goal more quickly and easily. Not at a persona level, at the individual level, just like you get in a branch. If we can orchestrate the digital experience for our customers, we can completely change the way that our existing apps look based on the customer's needs, both for the marketing side and the servicing functions, not just about sales. For those customers that are, let's say, still uncomfortable with digital platforms, we can make sure that there's more advice available naturally on the screen, that the directions are more clearly displayed. And for those that are digital natives that want a streamlined display, we can make sure there's far less on the screen. If you already know that 3 horizontal lines on top of each other means the menu, or the cog means the settings. And then we can take it further. If we're tracking our customers as they go through each of the journeys that we've defined, we can recognize that they've done unusual things. Maybe they've started other journeys and then not completed them. And we can nudge them back to complete a credit card onboarding process, perhaps. Maybe even merge it into the existing onboarding process that they're going through, so they only sign once and they get 2 products. At that point, processes stop being set in stone and become more customer first and not departmental led. And you start to see an improvement in your engagement across all those different channels that you're doing it on. Because by orchestrating unique experiences based around the customer's exact needs, rather than just that one size fits nobody platform to sort of meet the needs of everyone if you can, we remove friction. We create that platform that's always what the customer's looking for. And we start to create loyalty from the customer, because they see that we recognize that there's a human being behind every customer and account number, not just a revenue source. Of course, it doesn't hurt that human now has plenty more opportunities to painlessly give us more revenue, but the customer won't mind, because they're getting that relationship from us. My third point is that once we've focused on the why and the who, we need to look at the where. In this case, it's about becoming laser focused on where the customer sees the experience. And I'll be blunt, they don't see the hard work you're putting in on automating the back-end processes and removing manual labor from the journey to speed things up. It's important, so I'll come back to that very shortly, but the customer sees the experience at the interaction points with your organization. And that means that if you're going to take all the information you've learned from the why and the who, and then actually improve the experience, you have to think about the way you communicate. Not just digitally, because this is the point where we're going to have to swallow that bitter pill that bitter pill that Bob's been advising. And remember, there are a whole load of channels out there that customers want to use. Communication in banking and financial services it's a horrible mess today. I wish it wasn't so, but it's one of the last hidden bastions of utter chaos behind the scenes. Too many communications, too few at times, or at the wrong time, making absolutely no sense at times. And that's just because it's all so fragmented. I mean, have a think about the channels you communicate on today. I've stuck a load on the left-hand side, just highlighted in red there for you to take a look at. I know there's more. Just have a glance through them to get you going. And then ask yourself, who's responsible for the branding and the tone of voice when you communicate? Who owns the content? Which team or teams potentially owns the delivery of change to that content? How are each of those channels enhanced with each new communication for each new project you've got? What technology underpins each channel? And which team or teams control that technology? Are they all the same? If you can genuinely say that every channel is managed the same way, by the same people, using the same technology, and that you can deliver those highly personalized communications on all those channels to all your customers, I honestly take my hat off to you. But for those of you that aren't Quadient customers, it means that you can't communicate well. Maybe you don't have the technology on every channel to personalize the communication so that it means something valuable to your customers. Maybe you do have the tech, but it's 10 different products managed by 10 different teams. So you can communicate well, but only after 6 months of lead time and after a massive budget's been spent on making what should be BAU changes. So you can understand as much as you want about the customer and have enough intelligence to orchestrate those amazing, unique experiences to solve all of the problems that Bob suggested until it's coming out of your ears. But unless you can do something about it, it's very little use. And with so many channels being added, it's pretty normal to see that problem. Individual bits of gloss that needed to be added very quickly over time in the most recent years without that undercoat of really understanding where the impact of that would be, because, well, we just needed to deliver something really quickly, right? When I've been there, I know those difficult trade-offs. So to make sure you're communicating effectively, remember that, as Bob said, digital first doesn't mean digital only. To communicate effectively, we need to align our communications across every channel. And that means considering how we communicate the same message differently on every channel as well. We don't put addresses and signatures in emails the same way that we do for printed communications. We don't use them at all when it's content that's embedded in a web page or written into an SMS or a smartphone push message. Also remember that your core undercoat is in finding a solution that handles your channels for you. If you're having to synchronize messages across multiple technologies all the time, your costs are going to shoot up. You'll lose your speed to market. That gloss is going to soon peel off at that point. And finally, one that most people don't really get when it comes to communication and people trying to transform in this area to fix these experience problems. It's okay to assume success. Make sure your solution can handle the complexity you need today and tomorrow. Easy to start small. Assume that you might only need one-page communications or a simple SMS to solve the problem that you're looking at today. But assume that the project's going to be successful and your next project's going to be a little bit more complicated. And the next project after that might be a little bit more complicated again. Because remember, customers won't care if you try to explain to them that you bought the wrong product because you're only solving one problem and actually the solution can't quite do what you wanted it to do now. So you've degraded their experience. So we know why we're doing something. We know who we're doing it for, and where we're going to be laser focused to get the maximum impact. That makes my next point even more confusing because it's to widen your focus, taking the laser focus and changing it very slightly. So everything we've done so far has been focused on better outcomes for the customer, and that's absolutely critical. But don't forget to focus on interpreting it in terms of the sort of success that you need in your company. So what is the ideal outcome for you as the person leading this? And answering those questions usually means widening our who thinking to cover the employee experience as a critical component in the overall customer experience. And some quick tips in this area for you. To support the objectives of the people at the very, very top of the pyramid, if they're the people you're trying to impress, you're probably going to need to be seen to be creating a culture change in the organization, to become customer obsessed. Find ways of helping every employee see how their actions affect the customer experience and solve the problems that you're facing. Our customers have found that actually putting those living, breathing journey maps on every screen for every employee, it's helped them to see how their part of a process makes a difference. They start to take pride in beating their SLAs because they know that everyone else can see those same turnaround times and targets. Ultimately, the customer benefits. If you need to support your sector or your departmental objectives, you probably need to be seen as creating some sort of opportunity to transform your operating model. A lot of what we talked about today generates new revenue, and critically, it protects existing revenue when you get it right. But internally within a department, there's always pressure to reduce costs as well. If you can produce solutions that reduce the number of people required to make change happen, both through automation, as Bob's alluded to earlier, and through the consolidation of multiple technologies into one, that allows you to that one team to handle everything, and at the same time, you're transforming the customer experience. You can reduce costs, you can remove bottlenecks, maybe even bag yourself a seat at the top table for your ability to actually make transformation happen quickly when everyone else is taking forever. Our customers have found that they can significantly transfer capabilities from IT teams out to lines of business using the solutions, because what was previously very technical and disjointed in legacy solutions suddenly becomes simpler. It all looked and felt the same. So no need to learn 10 different technologies and programming languages. Just one business user-driven interface for everything. It's also critical for resolving skill shortages, especially those in those niche areas around specific legacy platforms where if you're not being held to ransom by your teams already, you're probably going to be very soon as those wages go higher and higher to retain those key employees, just to keep the lights on for platforms that may not even be adding that much value anymore, but you just can't get rid of at the moment. Finally, if you're looking to raise employee engagement down the line to those chipping away at the coalface all day, use those automation and consolidation options to show the IT experts how much easier their lives are going to be when they don't have to spend 95% of every day performing BAU maintenance tasks like manually changing a signature or amending a branch address. When it comes to communications, it's still a predominantly IT-driven environment for many financial institutions. And those cross-channel communications require a lot of IT people. Those IT resources are often pretty disengaged because they didn't join you to spend all day making content changes that someone in a line of business should really have been capable of making. You're going to release them to spend more time spending on the stuff they've been trained to do, like really difficult coding. My final point is to think about how you achieve this transformation. And it's something Bob finished with as well, the how. From my side, you may have guessed, I'd love you to use Quadient's Inspire platform to help you do that. At Quadient, we're really proud to support banks and financial services globally with customer experience solutions. Everything we do at the company focuses on the connection points you have with your customer. It's why our strapline is because connections matter. We're the only provider that allows you to quickly visualize the paths customers take through your organization and then put those maps on every computer across your company, and then track each customer and analyze their actions to make prioritization decisions that are scientific, not based on opinion, and then track the results of that change as well. We're the only provider that allows you to take all of that data and all the intelligence that you gather and then use our industry-leading orchestration capabilities to create those truly unique experiences across all those different channels. And we're the only provider that does all of that and then gives you an award-winning omni-channel platform for communicating all of that work with your customers across every channel, from microsites, digitally embedded content into existing apps and websites, all the way through email, WhatsApp, SMS, smartphone push messages, archive PDFs, and on into print. We think like a fintech, but we act like the 30-year-old, mature, publicly listed software provider that we actually are. So we're not limited by deployment methods. Our solution works whether you need something on premise or as infrastructure platform or a full software as a service. Our approach always tries to meet your needs. 8 of the 10 largest financial institutions in the world and half of the top 50, they already know the secret. They use our software to help meet their customers' needs. And we've got thousands of customers across all industries. We know that they're not just buying it and put it on the shelf because we've got a 97% CSAT rate. We'd be surprised if anyone can beat that in most industries. We know there's nobody in the customer experience and communication spaces that can come close. And we think it's because we practice what we preach. We focus on customers' experiences and their success, not just on selling softwares and services. We'd love for you to start your journey with us as well. my email address is on screen. Feel free to download the material that's available in the webinar today. Head to our website, drop us a message on the Contact Us link at the top. Tell them I sent you. Let's start a conversation about how you can create better outcomes for your customers that also create better outcomes for you on every channel. And with that, I will say thank you for listening to me. Thank you as always to Bob. I always learn so much when I hear you talk, and it makes me sort of nudges me to think differently when I end up in group think again. I'm going to hand back to Julie to see if we've got any questions.
Great. Yeah, great stuff, guys. Thank you for that. I always learn a lot on these webinars, so thank you. As a reminder to our audience, the Q&A box is in the lower left-hand corner on your screens, so feel free to submit your questions there. I'll go ahead and start with a couple we have here. We have about 12 minutes left on the call, so feel free to submit yours. So this first question is for Bob. It says, the slide asserting that the growth in digital customer utilization has not produced the promised decline in call volume is a bit hard to accept. Does Celent have any hard data there?
Yeah, great question, actually. So many of my slides had assertions on the slide titles, right? And those were my conclusions based on the data in hand. In this particular case, we have surveyed quantitative data suggesting that call volumes and wait times remain a pretty key priority among the majority of U.S. Financial services contact center executives, right? And so that wouldn't be a problem if call volumes were steeply declining as a result of growth in digital. I think what's really going on is more than one thing. So many institutions, as a result of COVID, saw call volumes related entirely to how COVID impacted people's lives, right? So net new call reasons into the contact center. So never mind digital acquisition or digital customer utilization. COVID created some net new call volume, and then brand new digitally active customers who've never interacted with a mobile banking app before started trying to do so because their branch was closed. Or they were unwilling to interact with an ATM because they're afraid about catching COVID by interacting with a surface that hundreds of others have interacted with. And so they're brand new mobile users. Of course, they had questions, and that generated that new call.
Okay, I think we've lost Julie. So I'm going to take a look at some of the questions. So what have we got here? Okay, interesting question here. What's the single best first step that I can recommend to my colleagues to make sure we put on the undercoat? So if I have a quick go at that one, and then Bob, maybe you chip in with your views as well, because I think my view on this would link into your previous answer. Actually, my biggest single thing that you could do is think like a customer, and don't assume that everyone has even the most basic level of maturity in the things that you do. Years ago, I used to talk about it in terms of talking bankish, using that language that bankers understand, but actually customers don't. And we've got really good at not doing that anymore. But we've replaced it with that natural understanding of what digital maturity might naturally be. And people don't get it. There are people that are just they're logging into digital banking for the first time, like you said, Bob. They've never actually done anything before, and they're really not comfortable with it. If you've heard me speak before, I quite often use a lot of personal examples, and from my family. And my mum's fiance is an incredibly clever person. He's recently retired. He is, he's got more than one home. He's got a lot of disposable income. He's the perfect customer for a bank. But when I spoke to him about digital, he says, "What you need to understand, Andrew, is I begin every digital experience with how do you turn this thing on." It's not something that I would even think about. And he bought a laptop recently, and I had to show him how to turn it on, and how you would log into something, and how not to hold a mouse like it's actually a live mouse by the tail. This isn't someone who's not very clever. He's phenomenally intelligent. He's just not good at it. So when we assume that there is any level of maturity at all, we can very easily be counting our potential customers and those revenue streams that we want to get out of the sort of areas that we want. And Bob, I don't know whether you've got any views on that one.
I think that's a great perspective. I was going to convey an engagement we had with a pretty large U.S. credit union a while back, and the CIO brought us in to help us kind of be a tiebreaker, I guess. They were having some conflict within the C-suite. Some in the C-suite were advocating her to quickly stand up new digital front-end capabilities because they had a comparatively young and digitally directed member base, and they were falling behind competitively. So quickly build these new digital capabilities in the front end. And her advocacy was, yeah, I could do that, but that's going to increase technical debt and increase costs later. The right approach is to work on the technology back-end infrastructure first. And then all these new digital capabilities are going to be comparatively fast and easy to implement. And so, like, I don't know that there's a right answer there. It depends on each financial institution, but my advocacy would be don't neglect either, right? And too many banks, I think it's changing now through COVID, but for too many institutions, digital was all about the user experience. Well, yes, great focus, but as Andrew was saying, there's much more to the back office that affects the user experience that's maybe not as obvious as the front end, and neither can be neglected.
Great, thanks for that.
Yeah,
sorry, I dropped off there briefly, but I'm back, and it looks like we do have one final question here, and that is, it looks like it's directed to Andrew. How would a credit union or a community bank do this? It sounds great, but complex and expensive for us smaller firms.
Okay. Yeah, and it can sound complex when there's not a lot of people around. You don't have an entire army of people to support you. But I would say, well, firstly, from a Quadient perspective, give us a call. We can help with that. But the way that we would help would be to start small. You don't need to boil the whole ocean or to bite everything off in one bite. So go journey by journey. Understand that your customer experience won't change overnight, even if you do have a full army of people available to do it. And actually, the more people you've got to do it, the more risk there is that you try and make sure that you understand your exact perfect future state before you actually want to even start changing anything. And that just means your customers are going to suffer. They're going to end up with the situation that they're in right now, where you're going to still end up with the unintended high call times and trying to shut branches while sales are actually increasing in them, all those different things. So start small. And actually, if you're smaller, it often means that you don't have quite so many overlapping legacy solutions that you're going to have to try and make work with your new world. So you may be sat there sort of panicking a little bit now, saying, I need to move into this new world and I don't know how to get there. But once you start moving, you can move a lot faster than a lot of the larger organizations can, where they might be trying to integrate 3 or 4 different CRM systems, for instance, or different core banking platforms that might do different parts of the solution in order to get all of that customer intelligence to do something. Bob, I don't know whether you've got a view on that, or whether I've just stolen your thunder, maybe.
No, not at all. I mean, yeah, classically, smaller organizations have smaller tech teams, less in-house expertise, right, and need to be more reliant on third parties, right? Got that. I think though the offsetting advantage for smaller organizations, it reminds me of the adage, right? Too many cooks in the kitchen can ruin supper, right? So many large organizations do have too many cooks in the kitchen, right? Too many people with their hands in the outcome and advocating for their own kind of self-interest. Smaller organizations where CIOs and others wear multiple hats can really produce a more agile outcome. So I think you're not necessarily at a disadvantage by being smaller and having smaller budgets.
Wonderful. Well, thank you, gentlemen. Looks like that's all we have time for today. Thanks so much to Bob Meara with Celent and Andrew Stevens with Quadient And of course, thank you all, our audience, for joining us.